For over 2 months, the stock market felt completely, utterly invincible. I mean, we were riding a historic 9-week winning streak straight into the record books. Then, a single day of absolute tech carnage shattered that entire illusion. If you think this is just a minor temporary dip, you're misreading the room. A massive structural shift just cracked open right under the surface, and your portfolio might be standing directly in the blast radius. A cool $1 trillion. Just vaporized. That is the jaw-dropping amount of market value wiped out from the AI and semiconductor sectors in one single brutal trading session. This wasn't just the AI frenzy stumbling, it slammed face first into a macroeconomic brick wall. We are watching a violent shift in investor psychology play out in real time, flipping from blind, momentum-chasing greed to outright panic basically overnight.
Think about what we've seen lately. For weeks, mega-cap tech stocks were basically acting like a cheat code. They single-handedly carried the broader markets to consecutive all-time highs, capping out at this massive 7,609 level on the S&P 500. It felt like the easy money was just never going to end. But on Friday, June 5th, that historic streak didn't just bend, it violently snapped. The S&P 500 plunged over 200 points to close out at 7,383. And this wasn't your standard, orderly pullback where people calmly take some chips off the table. No, this was a broad-based liquidation event that caught the retail crowd completely off guard. The sheer speed of this reversal left everyday growth investors holding the bag while the big players scrambled for the exits. But the real damage, that was in the tech-heavy NASDAQ. It didn't just slip, it cratered by a brutal 4.18%. We haven't seen a single day performance that awful in over a year. The tech undertow was so ferocious, it literally dragged down everything in its path, fundamentally rewiring the market structure in a matter of hours. And here is where you can actually see the institutional panic. The VIX, Wall Street's primary fear gauge, skyrocketed nearly 40% in a single afternoon. It surged right past the key 20 level. Why does that matter? Because mathematically, that is the exact threshold where big funds stop buying the dip and start desperately buying downside protection. If you were a retail trader holding unhedged positions through this, you likely got absolutely decimated by automated margin calls. So what actually triggered this sudden avalanche? The first major cracks formed inside the market's absolute favorite golden child, artificial intelligence. Earlier in the week, chip giant Broadcom posted what looked like stellar earnings. They showed off this massive $30 billion AI booking pipeline. Sounds incredible, right? But then came the catch. Management only maintained their full-year AI revenue guidance. They didn't raise it. And let me tell you, when you have an entire semiconductor sector priced for absolute, flawless execution, flat guidance is a slap in the face. It triggered an instant domino effect. Broadcom's stock collapsed 23%. Micron plummeted over 13% on staggering volume, driven by rumors that Nvidia's new Rubin platform might actually reduce memory capacity requirements. AMD dropped 11%. Qualcomm sank 10%. And Nvidia itself, the undisputed king of the AI trade, violently broke right through its critical support floor at $208. The flawless AI growth narrative just cracked wide open. But wait, the tech collapse is really only half the story here. Right as the AI sector was stumbling, a massive macroeconomic bombshell woke up the bears. Friday morning, the May non-farm payrolls report dropped. Wall Street consensus was betting the economy would add a modest 80,000 to 88,000 jobs. Instead, the economy added a roaring 172,000 jobs. It practically doubled expectations, and on top of that, previous months were revised significantly higher. Now, you might be thinking, hey, a booming job market? That's phenomenal news. And on paper, for the average American, it is. But in this highly distorted market regime we're trading in, good economic news is absolute poison for your stock portfolio. Why? Because a resilient labor market means consumer spending stays red hot. And if consumers keep spending, the stickiest parts of inflation are absolutely not going away anytime soon. Mix that red-hot employment data with gasoline prices surging past $4 a gallon right now due to geopolitical tensions, and you get an inflationary nightmare. The psychological pivot on Wall Street was instantaneous. The dream of near-term rate cuts, completely dead. The smart money is now pricing in a terrifying 72% probability that the Federal Reserve actually hikes rates by December. There is even a 50% chance we see a hike as early as November. The benchmark 10-year Treasury yield immediately blasted past 4.5%, which acts like heavy gravity on those high multiple growth stocks we were just talking about.
When risk-free government bonds yield that much guaranteed return, it changes the fundamental math for literally every asset on Earth. The surging US dollar and the high cost of holding assets shattered the illusion everywhere. Even spot gold suffered a historic single-day crash, dropping below $4,370 an ounce. It erased all of its 2026 gains in a flash. Cash is rapidly reclaiming the throne right now, and safe havens are getting violently repriced.
Which brings us to a massive, totally unresolved war taking place on Wall Street. On one side, you have the optimistic bulls. They look at this brutal tech rout and see the ultimate golden buying opportunity. They point to robust corporate earnings, like Broadcom's pipeline, and argue that a strong labor market means no recession. But on the exact opposite side, the macro bears are screaming that the structural cracks are finally exposed. They argue mega-cap tech valuations have totally divorced from reality, and with sticky inflation forcing the Fed's hand, a massive fundamental repricing of risk is long overdue.
If you want to know who is actually winning that war, don't listen to what they say. Look at where the big money is hiding. Instead of liquidating everything and moving entirely to cash, massive institutional capital quietly ditched speculative tech and sprinted straight into the boring, predictable safety of consumer defensive giants. While tech was in absolute meltdown mode, Coca-Cola surged 3.6% thanks to their organic pricing power. Eli Lilly broke out to hit a fresh all-time high of $1,131. United Health Group jumped on improving profit margins. This divergence right here, this is the silent signature of smart money bracing for serious turbulence.
So, looking to next week, we are staring down two very distinct, critical paths. Scenario A, institutional buyers step in early to defend the S&P 500's key support zone at 7,330. They systematically rotate capital, stabilize the indexes, and let tech undergo a healthy, normal consolidation. But scenario B is much darker. If the market fails to hold those exact mathematical pivot points, automated algorithmic trading programs will take over, potentially triggering a cascading sell-off down to the 50-day moving average. And remember, that downside could be heavily amplified because a ton of institutional cash is currently being sucked out of the broader market to prepare for that massive upcoming SpaceX IPO.
The ultimate battleground is set. The era of blindly chasing momentum just collided head-on with a hawkish reality check. So the question for your capital right now is simple. Are you treating this brutal tech dip as a temporary discount to load up on? Or are you packing up your portfolio and rotating into defensive safety before the Federal Reserve strikes again? Let me know which side of the trade you're taking in the comments below.
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.